Hello and welcome to today's Office Hours presentation. This is Paul Hoyt, your host. Our Office Hours presentation, or a relaxed informal mentoring program that we hold every Monday at noon Pacific time. All these recording slides and exercises are archived in the members area of our website, and the recordings are currently available on my YouTube channel at youtube.com/user/Paul Hoyt. The reasons we do office hours is because we know that being a successful small business owner can be a great experience, but we also know that it's tough. We know that you need education, training, tools, and teamwork to be successful, and we want you to get to know us. Because when you get to know us, you'll know first and most importantly that we care about you. We want you to succeed in every area of your life, whatever that means to you. We want you to find the greatness, the happiness, the divinity within yourself, and then remember it, embrace it, and live it every single day as we try to do. Our passion is to increase the survival rate, accelerate the growth rate, and reduce the struggle rate of businesses in America. And our vision is to help millions of CEOs and entrepreneurs get clear and stay focused so they can grow faster and enjoy greater harmony and balance in their lives. If you find these office hours presentations beneficial, please pass the word. You all know other business owners or people who want to be business owners, and they can gain great benefit from these office hours presentations just like you have. Our office hours agenda is usually an in-depth discussion of a business success principle, and we offer some closing remarks, special offers, and an invitation for next week's session, and then we go into open Q&A and coaching, where the best comment or question wins. In some cases, I work with people, Stephanie works with people to help them edit and polish documents, or we give a free coaching strategy session. So we really want to encourage you to be interactive as we go through the presentation today. Write down your questions, or better yet, type them into the chat log, and we'll answer them when we get to the Q&A portion of the presentation. We invite you to join us in the Awakened CEO communities on both LinkedIn and Facebook, where we publish a business success principle of the day on both Facebook and LinkedIn about 4 days a week. And I publish the Energy of the Day posting every morning on Facebook. When I get up every morning, I try to say something insightful or inspirational. And today was day number 1090 in a row. In 5 days, it'll be 3 years of every single morning getting up and posting an Energy of the Day message, which I'm going to celebrate that here in about 5 days or so. Today's topic is on Numbers Don't Lie, reading your financial statements. We always try to relate the subject matter of the day to one or more of the key performance areas of success, and today it's all about financial management. Today we're going to focus on financial management, which is one of my very favorite of the 7 key performance areas. We also relate the subject matter of the day to one or more of the cells in the Awakened CEO system, which is the integration in between different levels of performance, your mindset, your methods, and your momentum, and different areas of growth, business growth, professional growth, and personal growth. And today we're going to be talking about mindset for both business growth and professional growth, and we're going to be talking about methods that you can use to grow your business faster and achieve better financial results for your business. Today we're going to talk about the purpose of financial statements. We're going to talk about the income statement, the balance sheet, and the cash flow statement. And then we're going to sum it all up and talk about the bottom line. So let's just jump in and get started. Cash flow statements financial statements are the standard way of commuting financial status and financial projections between you and anyone else who has a right to know or a need to know how the company is doing financially. That can include bankers, potential investors, potential partners, potential teammates, other potential founders, anybody that you want to really see what's going on with the business so that they really understand it. It can be a tremendous source of information for them, and it can be a tremendous discussion document, both internally and externally with your business. All of the financial statements are created with what they call GAAP principles, GAAP, which stands for Generally Accepted Accounting Principles. And yes, there are generally accepted ways in which we create the income statement, the balance sheet, and the cash flow statement. The purpose of the financial statements, again, is to facilitate running your business by the numbers, and that's really, really important. The alternative to running your business by the numbers is running your business by the seat of your pants, and you're usually leaving money on the table whenever you do that. The financial statements provide the basis of information that is required for you to file taxes, and they provide a lot of information that's extremely helpful in running the business. And I want to say just a little word here about tax accounting versus managerial accounting. Tax accounting is organizing all of your accounting records and producing financial statements in a way that facilitates the production of tax returns and fairly discloses your tax liability to those who really care about that, such as the federal and the state governments and perhaps city governments as well. Managerial accounting, on the other hand, is a way of organizing the accounts in your financial statements and organizing your account structure so that it facilitates the management of the business. And those two are different principles. What I see a lot is that people who have organized their income statement so a way that really facilitates tax accounting but doesn't facilitate managerial accounting. We're going to talk a little bit more about that when we jump into the income statement, which is right now. The income statement is one of the three, and I think there's an argument to be said that it's the most important of the financial statements. It's also called the profit and loss statement. I have no idea why it has two different names, but the income statement is exactly the same as the profit and loss statement. And we hope, of course, that yours is a profit statement. It shows you where your money is coming from, all of your revenue sources, all of your revenue streams, and it also shows you where your money is going to, all of the different expense categories that are shown on your income statement. And it helps you determine your break even and helps you run your business according to a budget. The income statement has several different sections to it. It has the revenues, then the direct costs, which is also called the cost of goods sold or variable costs. The third typical section is the operating expenses, which are also known as the general and administrative expenses or the fixed costs. And then we see other expenses. Those are the four traditional sections to an income statement. We're going to run through each one of those sections here for a second and then give you some examples of that. Revenues typically will be by product or by service area, where you express, here are the revenues I got from product A and the revenues I got from products B and the revenues I got from product C or services A and B, less the returns and allowances that we had to give on those revenue numbers. And by the way, the managerial accounting part of it is tracking those returns separately because we want that to be a fairly low number, like 1 or 2%, something like that. If you see your returns being up in the 5 or 10 or 15% area, then you know you have an issue with your salesmanship or an issue with the value that you're really bringing to your clients. So we want those returns to be very, very low. You can also organize your revenues according to locations or channels in which you sell things. So for example, you could report revenue by retail channels and revenue by wholesale channels and revenue by internet channels, and again, less the returns that we have. So you have flexibility, and this is the flexibility of tax accounting versus managerial accounting, of how you report your revenue on your income statement. And the idea is we wanted to report it in a way that really best facilitates the running of your business. The next section in the income statement is direct costs. Indirect costs can include things like commissions, all of your internal commissions, and your external commissions, which can be to agents and brokers and affiliates and referral sources. And don't forget, by the way, that for most companies, that even when they have an external commission, they'll also have an internal commission, typically much less than they would if the internal salesperson handled the entire sale. But there's usually some element of internal commission that corresponds with every element of external commission. Other categories in the direct costs section of the income statement could include royalties and credit card fees and product costs, which is also called cost of goods sold, and subcontractor or delivery costs. And each one of those is reflected separately in the direct costs so that we can calculate our gross profit. A lot more on that in a second. The third section in the income statement is the operating expenses. And oh my goodness, there are a lot of them. You could have up to 30 different categories of operating expenses or fixed expenses: automobiles, bank fees, communications, dues and subscriptions, education, employee relations, legal fees, marketing fees, office rent, payroll taxes, printing. But wait, there's more: product development, professional fees, software fees, sanitation, the amount that you pay to have somebody help you clean things up, travel and entertainment, uniforms, and utilities. When I do financial projections for someone, this usually takes a long time to go through all of the different categories of expenses that you have in the operating expense section of the financial statement. And the fourth section we'll get to in a second. But first, let's talk about gross profit, because that's really, really an important concept with the income statement. Your gross profit is your revenues minus your direct costs. And it shows you how much money you really get from a sale that is left over to pay for operating expenses and taxes, and left over for profit that you take home at the end of the day. Your target gross profit for most businesses is 50%. I've seen some businesses that will run very effectively on a gross profit or a gross margin of 25 or 30%. But for most people, you want your gross margin to be 50% or even more. With some businesses, it's nice to have 60 or 70%. With information products businesses, you can have a gross margin as high as 80 or 90%. The gross profit really helps you calculate your break-even point, and that's really, really important to know. Your break-even point is when your gross profit is equal to your operating expenses. In other words, you have completely broken even. You haven't made any money, you haven't lost any money, you've broken even. It's important for you to know that, because you need to know how many units you have to sell, especially if you're a single product line company. Your units to break even is your operating expenses divided by the gross profit of each one of the units. And the revenues to break even is the operating expenses divided by your gross margin. Here's an example of that I hope will clear that up a little bit. If you make $5 of gross profit on every sale that you make, and you have $5,000 worth of operating expenses, then you need to sell 1,000 units to break even. So whether those units cost $50 and you have a 10% gross margin, or those units cost $10 and you have a 50% gross margin, doesn't make any difference. What really makes the difference is how much gross profit you have on every unit that you sell. In the same example, in this particular example, if you have a 50% gross margin and $5,000 worth of operating expenses, you need to sell $10,000 worth of revenue, which generates the $5,000 worth of gross profit, which allows you to break even, not making money, not losing money, but you're breaking even because your gross profit is equal to your operating expenses. With the income statement, it shows you several key things that are used a tremendous amount when it comes to managerial accounting. It shows you your operating income, or your EBITDA. That's a really important accounting term for you to know. Your EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's important for you to know that because it's often used to calculate the value of your company. In many valuation methodologies, we take some reasonable valuation multiple and multiply it times the EBITDA in order to get the current fair market value for your company. The income statement will also show you your taxable income, which is the operating income less other expenses such as interest, taxes, depreciation, amortization, everything that shows up in the EBITDA framework itself. And it shows you your net income, which is how much that you have left over after the taxes have been paid. Here's an example that I hope will clear it up a little bit. In this particular example, the company had $10,000 worth of gross revenue, or top line revenue, $5,000 in direct costs, which yielded a gross profit of $5,000. And again, direct costs could be considered to be variable costs or cost of goods sold, depending on the nature of the business that you have. $10,000 worth of revenue, $5,000 worth of direct cost, yielding $5,000 worth of gross profit. They had $3,000 worth of operating expenses, yielding an operating income of $2,000, which is also the EBITDA. The earnings before interest, taxes, depreciation, and amortization was $2,000. They had other expenses of $500, giving them a taxable income of $1,500. We reserve 30% of that, or $450, for taxes, which gives us a net income of $1,050. So this $10,000 worth of revenue was reduced by direct costs, operating expenses, other expenses, and a reserve for taxes to get us a net income of $1,050, which is 10.5%, which, by the way, is not particularly bad. Many very, very large companies run 5.5%, 6% net income. Small companies can run a lot more than that. It's possible to run 20, 30%. I've seen some companies run as high as 40% net income, but it's very unusual. And here's a tip. Most investors will start to get a little skeptical and a little nervous if you're suggesting to them that you're going to run an operating income or a net income percent that's in excess of 15 or 20%, because that's really good. Most really profitable companies run a net income percent of less than 10%. Here's another income statement example. In this income statement example, we show exactly the same information that we had before, but this time we're comparing it to a budget. So in the budget here, we had thought that we were going to get $12,000 worth of revenue, but we only got $10,000, so we had a negative variance of $2,000. We thought that our direct costs were going to be $6,000, but they were only $5,000 because our revenue was down. So we had a variance of $1,000. So our gross profit was $1,000 less than we thought that it was going to be. Our operating expenses were $500 less than we thought that they were going to be. So we had a positive variance on operating income. And other expenses were exactly what we thought that they were going to be. So our taxable income was $500 less than we hoped that it was going to be according to our budget. Our reserve for taxes was less, so our net income was $350 less. This is the way that an income statement is used to help you run your business by the number. And that is by creating budgets for your business and then comparing your actual results to those budgetary numbers, which gives you your income statement example. Next, let's talk about the balance sheet. The balance sheet is the second of the financial statements, and I think the second most important one too. Its purpose is to show the assets of the company, in other words, what the company owns, the liabilities of the company, which is what the company owes to other people, and equity of the company, which is what is left over and who it belongs to. It really helps your company build the asset value of your company and fairly express the asset value of your company to those who may want to lend you money, or those who may want to invest in your company, or those who may want to join your company. So together, the income statement and balance sheet are almost always given to people who may want to lend you money or invest in the company or join the company in some particular way. In the balance sheet, the sections of the balance sheet are as follows. The asset section will have things like cash, accounts receivable, inventory, trucks and automobiles, which are fixed assets, building and lands, which are other really big fixed assets, furniture and fixtures, and intellectual property is also the thing that you will find in the assets section of your financial statement. In the liabilities section of the financial statement, you'll see accounts payable, taxes payable, salaries payable, notes payable, or loans to other people. So this is the money, the assets that the company currently have, which are obligated or encumbered in some way, that they really belong to somebody else instead of the owners of the company because you have an obligation to pay them via accounts payable or taxes payable or salaries payable or a loan debt that you have. And what's left over is the equity. And in the equity section on your balance sheet, you have to have capital accounts for each of the owners or investors at your company, and then typically some other accounts that show the distribution and the impact of net income, which is also called retained earnings. And those are often listed separately. So here's an example of a balance sheet. In this particular company, they've got $10,000 in cash. They have $5,000 in accounts receivable and $10,000 in inventory, giving them total assets of $25,000. Of that $25,000, they owe $12,000 to other people in accounts payable, so their total liabilities are $12,000, and the owner's equity then is the difference in between the assets that you have and the liabilities that you owe, which in this case is $13,000. And the balance sheet is in balance because the total assets equals the total liabilities and equity. And that's what a balance sheet means. It means that we have struck a balance and we understand who owns all of the assets of the company, and the liabilities and the equity together are equal to the assets of the company. The third type of financial statement is a cash flow statement. With the cash flow statement, its purpose is to show where the cash is coming from and where the cash is going to. And there are two different formats for the cash flow statement. One of them shows the sources of funds and the uses of funds, and the other one shows the net impact of operating activities, investing activities, and financial activities. Let's talk about that second format first, and then we'll come back and show you the first format. In the second format, we typically show the net cash from operating activities. And in this example, we had net income, which, by the way, had subtracted out depreciation and amortization, which is really not a cash-generating activity or consuming activity, so we added that back in. We decreased our accounts payable, which consumed our cash. We increased our inventory, which consumed more cash. So instead of getting $1,500 in cash from our net income, we only got $500. And in this particular example, we bought an automobile. So we added an asset to the company of $25,000, which, if we had paid for it all up front, would have consumed $25,000 in cash. But we didn't. We borrowed $22,500 against it. So we decreased the cash through the purchase of an automobile, but we increased the cash through the net impact of our financing activities, which was by getting a loan against the automobile that we just purchased. So those two kind of balance each other out, and our net cash impact from all activities is a negative $2,000. We gained $500 from the impact of our operating activities, and we lost $2,000 from the combined impact of purchasing the fixed asset and getting a loan against that. So if we started out at the beginning of the month with $10,000, we end up at the end of the month with $8,000. Here's this exact same stuff shown in the example of the sources and uses form of the financial statement. In this case, we got $1,500 from net income, we got $500 from depreciation and amortization, and we got $22,500 from the bank who loaned us money to help pay for the car. So we increased the cash $24,500. We paid down our accounts payable, we increased our inventory, and we increased our fixed assets so that we used $26,500 in our funds, which gave us a net impact of $2,000. And if we began the month at $10,000, we ended the month at $8,000. That's a lot of information when it comes to the cash flow statement, but it's extremely valuable information. So you know at a real gut level, at a subconscious level, where your money is coming from and where your money is going to, because you can have a profit as far as the income statement is concerned, but actually go out of business because you are spending cash much quicker than you are generating cash. and we don't want that to happen to you. I've seen more businesses go out of business, not because they weren't making the revenue, but because they were spending cash too quickly, investing in intellectual property, investing in furnitures and fixtures, investing in other kinds of things, investing in inventory, all of those ways that were consuming the cash at the company that they really needed for working capital in order to keep their doors open. So here's the bottom line. The bottom line is, when you are the CEO of a company, when you own a company, being able to read financial statements is really not optional. You really need to be able to do that. But here's the really good news. It's not that hard. If you get somebody on your team who understands that and can walk you through them with just a few minutes each month, just an hour each month of going through your financial statements and allowing you to ask questions about them and really digging into the information that is given to you therein, can really help you run the business. Because to optimize a system, you really have to know your metrics. That which is measured improves, and if you really want to increase the profits at your company, if you want to increase the market value of your company, you have to be able to keep score. And your financial statements are your scorecard. One other tip for you, there are always surprises. There's always surprises in the financial statements. You thought that you were making the most money via retail sales, and it turns out you're making the most money via wholesale sales. You thought that your gross margin was 50%, and it turns out to only be 42%. You thought that your operating expenses were only going to be $15,000 a month, and they turn out to be $18,500 a month. And when you have accurate financial statements at your company, you have the opportunity then to dig into those surprises and find out what's really going on and take corrective action. With the Awakened CEO system, as we talked about earlier, financial statements, we want to talk about it in terms of mindset and methods. First of all, from a mindset point of view, I want you to know deep in your subconscious mind that there's extremely valuable information for you and your company hidden in those financial statements. When in many cases, it's obvious in the financial statements. And I want you to believe that you can learn how to read those financial statements and understand them and really know what the numbers are trying to tell you, so you can get that information for yourself and you can run your business more effectively. And I also want you to get that running a business by the seat of your pants can cost you a tremendous amount of money. There can be thousands and thousands, tens of thousands, even hundreds of thousands of dollars of extremely valuable information in your financial statements if you just care to take a look at that. And fortunately, again, it's not that hard. Just study accounting terminology, understand the basic terminology that we introduced here today: top-line revenue, direct costs, gross profit, gross margin, operating expenses, EBITDA, other expenses, taxable income, net income, assets, liabilities, equity, sources of fund, uses of fund. There's only like these 15 or 20 different terms that you need to understand and be familiar with, and you can learn them. It might take you a few hours, but I know that you can do that if you just study a little bit. And work with experienced professionals when appropriate to help you make sure that you are keeping track of your finances correctly and that you, as the owner of the business, understands those. I really encourage you to organize your accounts and your reports to help you better manage the business. Remember, we talked about tax accounting versus managerial accounting. You have a lot of flexibility in the way that you report the expenses and the income at your business, so that it really facilitates the operations of the business, the running of the business. And I strongly encourage you for a method to close the books and generate your financial statements and review them every single month. That is a best practice, and for most businesses, it is absolutely essential to do that. I know that I've been doing that every single month for the last 15 years at my business, and you can learn a lot about what's working and what's not working by doing that with your financial statements. So that's been our agenda for today. We talked about the purpose of financial statements. We talked a lot about the income statement and the balance sheet and the cash flow statement, and summed it all up for the bottom line. And here's your homework and your exercises. Implement QuickBooks or some other system that provides financial statements very easily. Print out the financial statements every single month and study them, and create a budget. I really encourage you to create a budget and then manage your business by the budget, every single month. And of course, get help if you need it. Find competent accounting professionals to come in and help you with your business anytime that you need that. If you want to learn more about financial information, we've got several office hours presentations that you may find of interest to yourself. Number 19 was on taking credit cards and getting the money that way. 32 is on credit and collections. 107 is on how to be great at financial management in general. 121 was on financial modeling, and 138, just a few weeks ago, 4 weeks ago, was on cash flow secrets. You'll learn a lot more about the cash flow statement itself and learn some valuable tips about how you can increase the cash that's flowing through your business if you watch Office Hours number 138. Here in just a minute, we're going to go into open Q&A and coaching. First, comments and questions on the topic of the day, and then anything else that you want to talk about. And tell me what your biggest takeaways are and insights that you gained from the presentation today, and let us know what you're going to focus on. The Awakened CEO system, which is what I pioneered here at my company just a couple of years ago, is really focused on helping you run a more profitable business. We want you to get clear, stay focused, and grow faster so you can make more money. We want you to become a more powerful leader and make better decisions so you can keep more of the money that you make. And we want you to gain wisdom and grow stronger so you can enjoy greater peace and harmony in your life. As we said earlier, that starting and growing a business can be a wonderful experience, but it takes support, it takes help, it takes effort in order to do that. And we are passionate about doing everything that we can to help your journey of business be the most profitable and the most pleasurable one possible. Our support services including teaching you and educating you so you can do things for yourself, doing things with you like financial projections and business plans and product funnels and sales scripts, and in some cases doing it for you, operating as your CFO or your COO or general administrative support to help you start and grow your business. With the Awakened CEO system, it is the integration between all of the different areas of growth and the levels of performance. The levels of performance being your mindset, how you think and feel about different things, your methods, what you actually do, how you do things, and your momentum, getting into action and building momentum over time, and your business growth area, the professional growth area, and personal growth area. It's really important for you to focus on these different areas of growth because almost every breakthrough in business performance is preceded by a personal breakthrough of some kind. Let me say that again. Almost every time you have a breakthrough in business performance, it's preceded by a personal breakthrough of some kind. You have learned to and courageously stepped forward and gotten around or over or under, through, or eliminated some blocks of mindset, some blocks of methods, some blocks of behavior in some way that was preventing you from building the business that you wanted to build. And we don't want to see that happen to you. And that's why we focus with the Awakened CEO system on all of the different areas of growth, because it's not just enough to focus on business growth. You also have to focus on professional growth and personal growth in order to build the strongest business possible while you are enjoying life as much as possible as well. Our next office hours is on November 21st. That's a week from today. I don't know what we're going to talk about yet, so let me know. It might be group coaching next week, or it could be a presentation from Stephanie. We're not quite sure about what we're going to do. I do know that I am out 4 days later this week, so we may end up doing that. And actually, I think I just got a note from Stephanie. Next week, it's going to be on event management and how to have a successful event. So thank you, Stephanie, for that reminder. We'll be talking about that, and it's going to be her delivering the presentation next week, which I'm delighted at. I'm going to take a break. And she is an absolute expert, by the way, in event management. She's done it for years and years, and it's been a really boost to our business to have her expertise, and it can be a boost to yours as well. So next Monday, we'll talk about event management. In between now and then, let us know what else you would like for us to talk about by going to paulsurvey.com. And in between now and the time that we talk again, do your homework. Make sure that you're doing your bookkeeping, your accounting the way that you need to do it. Find somebody on your team who can help explain the financial statements to you if you don't know how to do it, and do your homework in between now and next week. With that, let's open it up to open Q&A and coaching. Stephanie, do you have any questions for today?
I do.
Okay.
Let's see, first one. I sell my products through a lot of channels. Should I organize my income statement to reflect that?
You want to organize the income statement so that it tells it so it really facilitates the management of your company. So for example, if I decide that I've got 3 product lines at my company, and over time product line A has been representing 70% of my revenue, and product line B was 20%, and product line C was 10%. But I want to change that so it's more balanced. I want to make it so it's 60-20-20 or 50-30-20 or something like that. You might want to organize your income statement so it reports to you every single month how you're doing on your goal of having a more balanced sales when you analyze it by product line. Same goes if your wholesale sales are 90% of your sales, and your retail sales are 8% of your sales, and your internet sales are only 2% of your sales, but you want to change that over time to where it's more balanced. Say that 20% of your sales in total are retail in some way, either through retail channels, of your own retail channels like back of the room presentations or events that you have at trade shows and state fairs and those type of things, or selling them through the internet. You might want to organize your balance sheet, or your income statement that way. It really depends on your business. However you organize it, though, I do encourage you to get some reporting out of your financial system that gives you the other type of information. So if you organize your income statement by product or product line, or if you organize your income statement by the different channels in which you sell it, then make sure that you're getting other reports out of your system, not just the income statement, but somehow doing sales analysis reports that is by that other way of categorizing your income, so that you get all of the information that you need to properly manage and run your business. So I think the real point there is that you don't have to just settle for the way that the information is being produced on your income statement. Dig into the information. Grab information out of QuickBooks or whatever other financial system that you have, and pull it into a spreadsheet and sort it in a way that facilitates managing your business, because you can really only have one of those different ways of reporting your income on the income statement. And it's up to you as a manager of your company to be able to pull the information out so you can get that valuable information that's not shown on the income statement. Hopefully that was helpful to you. Stephanie, do we have next comment or question?
Yep, we do.
Okay.
This one's about balance sheets. Balance sheets are snapshots, whereas profit and loss statements and cash flow statements are running record. Can you talk more about that?
Yeah, I can. So profit and loss, and by the way, great observation. That's exactly right. A balance sheet is your asset position at a single point in time, usually the end of the last month or the end of the last year. P&L, however, is often reported as a range of dates, like a year-to-date P&L, or a quarter-to-date P&L, or a month-to-date P&L, or your profit and loss, or your income and expenses for just this last month. And it's the nature of the accounting system as in general, generally acceptable accounting principles say that that's the way that it's going to be. That your balance sheet is a snapshot as of a single point in time. Now, by the way, whenever I analyze companies' financial performance, I ask for month-to-month P&L statements and month-to-month balance sheets, because I want to see how the balance sheet is going up and down over time as the profit and loss is being reported in that same period of time. The reason why we want to look at that is because seeing the balance sheet as a snapshot doesn't really tell you the story of the business. Here's an example. If your inventory varies in between $100,000 and $500,000 in any one particular month, you might see that your cash is extremely high or your cash is extremely low. Without seeing the balance sheet reported at the end of each month, you wouldn't be able to see that fluctuation because you'd only be looking at the snapshot. So even though the balance sheet is just a snapshot, my encouragement to you is to give a snapshot at the end of each month and then watch the changes over time, because that will really help you understand how cash is moving in and out of your business, how your assets are growing and shrinking, how your equity position is growing and shrinking over time as the business fluctuates. So that was an important distinction. I'm glad that you asked that question. Next question, Stephanie.
Okay. Because the different financial languaging is so varied, can you recommend a good financial dictionary?
No, I really can't. But I do. If you just go online and search for a particular accounting term, you will typically get, I know I always use Google, whenever you search on things like gross margin or gross profit or markup or any of the other accounting terms that we've talked about today, you'll get a response from both Wikipedia and Wiktionary, and you'll get one from Investopedia. So there's lots of sources of information. And I would take a look at all of those in combination. Investopedia, I think, is the one that has the best financial information, but Wiktionary and Wikipedia also have that financial information. If you go look at 2 or 3 different sources of definitions, hopefully that will make those terms be much more obvious to you. And again, as I've said many times today, get yourself a competent accounting professional who will sit and take the time to help explain those concepts to you in a language that really helps you understand it. Because the concepts are really not that difficult, but oftentimes when we take a simple concept and we put a complex word with it, like gross margin or equity or liabilities and assets, it confuses things a little bit. So get somebody on your team who can explain those terms to you in layman's language, and you'll get it pretty quickly. Hopefully that helps. Next question or comment, Stephanie.
Okay. Do you have any tips for interpreting the numbers as an investor? Should I get outside help for reading the numbers before I invest?
Absolutely. Absolutely, you should get the numbers. And typically, when you're an investor at the company, you're looking at 2 sorts of numbers. You're looking at the historical financial performance, and you're looking at the projections of what the company believes they're going to be able to do with your investment and the investment of other people. If you're not familiar with taking a look at financial performance and familiar with looking at financial projections, then yes, get somebody on your team. If it's a $150 investment in some crowdfunding enterprise, it doesn't make sense for you to go spend $500 on an accounting professional to help explain the projections to you. But if you're thinking about making a $50,000 investment or a $500,000 investment, it does pay to have a competent professional go out and take a look at the entire investment opportunity, not just the numbers, but everything else that they're talking about too, the strategy. And it's been my pleasure over the years to provide that valuable resource to angel investor groups and to individuals who are considering writing very, very large checks to other companies. They hire me to come in and take a look at the business from top to bottom. And that means taking a look at the strategy, looking at every element of the business plan, looking at the team, looking at their competitive positioning, their marketing results and their marketing materials, looking at their website, looking at their financial performance in every line item, and looking at their financial projections and seeing what I can see to be an objective third party to help them see things that they wouldn't otherwise see. And I know many times that people have paid me to come in to take a look at an investment opportunity and then decided not to invest because I spotted something that they didn't see. I saw that they were not fairly representing their competitive positioning. I remember that one extremely well. A guy was getting ready to write a check for $250,000, and the business plan had represented their competitive positioning as being one thing. And when I did some very basic research, I found out that it wasn't true at all, that they were being deceptive and misleading in their presentation of what the competitive positioning was. I remember another one where I went in and somebody had presented some pictures and when I went online and looked at Google Earth, I found that their representation of their physical facilities wasn't what it needs to be. And of course, I've gone in and looked at financial statements, and I've seen that in the past, those financial statements were not done correctly. I looked at one just a few months ago where somebody had a capital lease on the books, but they were not depreciating the asset the way that they should were. And they frankly were not tracking and doing the accounting on a capital lease the way that they should have done so with generally accepted accounting principles. So the short answer is absolutely yes. Unless you're a competent financial professional, or you're just going to make a $200 or $300 or $500 contribution, as it were, or investment in a company, then by all means have somebody on your team that can help you take a look at that investment opportunity before you write that check for $10,000 or $50,000 or more. I guarantee you'll be glad that you did. You might decide not to write the check at all. You might decide to write a bigger check, depending upon what the objective third party comes in and shares with you about the information they're able to review. Hopefully that's helpful to you as well. We got some time, Stephanie. Do we have any more questions?
Yes, we do. You're
Awesome.
on a roll.
Okay.
I'm glad it's you and not me answering these questions. Shoot, I get really nervous when I think about learning all this accounting stuff. Is there a way to simplify it? No kidding.
You know, I don't know that there is a way to simplify it other than, presentations like the one I gave you today and the advice that I gave you about getting a competent professional to help walk through that. If you're really struggling with that, it's probably a mindset issue. It could be that, you weren't good in math in middle school and high school. It could be that, your own financial performance has not been very as good as you'd like for it to be. So you have this mindset, this resistance to looking at financial records at all, to balancing the checkbook and seeing how much you owe other people. And that personal financial attitude, that mindset can carry over to your business, but you got to overcome it when it's your business, because if you don't learn to read financial statements and learn to objectively and courageously look at your financial performance, it'll be worse than it would be otherwise. Because as I said several times, running a business by the seat of your pants without taking a look at the financial performance at least every month, it just means to me that you're leaving money on the table, because there's surprises in those financial statements every single time that will enable you to run a more profitable business if you just take a look at that and do it. So my encouragement to you is to suck it up. Be bold, be brave, be courageous. Get somebody on your team who cares about you, who can see the humor in the whole thing and can help you go through that and learn what you need to learn to run a more profitable, sustainable, and scalable business over time. Hopefully that helps. Any more questions, Stephanie, or are we complete for today?
No, we've got a couple more.
Awesome. Let's go for it. We got some more time.
Should I prepare budgets for next year, and how do I do that?
And the answer is absolutely yes. I'm a really big believer in setting goals and then understanding what it's going to take for you to achieve those goals, from a financial performance perspective. In our Awaken CEO Quick Start program, our Clarity package, we always end up with a budget. I mean, that's really, really important for you to understand how much money it's going to take for you to execute your growth strategies and figure out how much money you plan to make. Are you planning on just taking home a couple of $1,000s a month, or are you planning on taking home $10,000 a month, or even more than that? And the budgets will tell you what your strategies really mean to you from a financial performance point of view. So yes, it's important for you to create budgets and that correspond with the goals. You know, my goal is to have $500,000 in gross revenue next year, to have $300,000 worth of gross profit, and to have $100,000 worth of taxable income, or $200,000 worth of taxable income. You don't have to prepare detailed line item budgets, although that can be very, very helpful when it comes to controlling expenses, but at least prepare a budget at a high level. This is what I want my top line revenue to be. This is what my gross profit is likely to be. These are what my operating expenses are going to be. And so this is what my operating income are going to be. Prepare budgets on at least those 4 items so that you can run your business. And when you get a little more sophisticated, when you have somebody on your team who can really help with the books, can help with the accounting of it, then you can go into detailed budgets for each one of the 30 different operating expenses so that you can have a budget for insurance and for marketing and for research and development and for supplies and for storage and for all of those different things out there. So yes, prepare a budget at least at a high level. And when you get more sophisticated, then you can provide detailed line item budgets for all of the different revenue categories, all of the different direct cost categories, and all of the different operating expenses and other expense categories. Yep, do it. And of course, if there's a way that we can help, you know, please let us know. We'd be happy to have that conversation with you. Next question or comment, Stephanie.
Okay. What's the difference between gross profit and gross margin? Aren't they interchangeable? And what about markup? Is that the same as gross profit?
They're not interchangeable, but many people do make the mistake of almost using the terms synonymously. So technically speaking, gross profit is a dollar amount and gross margin is a percentage. So if you had $10,000 worth of revenue and $5,000 worth of direct cost, your gross profit was $5,000 and your gross margin is 50%. The gross margin is the gross profit divided by the total income, and it is always properly expressed as a percentage point. Now, by the way, I made that mistake for like 40 years. It wasn't until about 10 or 15 years ago, after I'd actually started being a business consultant, that a really great tax professional pointed out that I was using those terms incorrectly at that time. And so I corrected it, and I've certainly learned them or used them correctly since that time. But it's a pretty common mistake. Gross profit is a dollar amount, though, and gross margin is a percentage. And by the way, markup is also a percentage, but it's the inverse of the cost that you have. It's the inverse of the inverse of the gross margin. So for example, if something costs us $25 to make and we sell it for $100, that's a markup of 400%. We took the cost and we multiplied it by 4 in order to get the retail price. If it costs us $25 and we sell it wholesale for $50, that's a markup from cost to wholesale price of 200%, or excuse me, of 100%. We doubled the price. We took the price of $25 and multiplied that times 2, which is an increase of 100% or a markup of 100% in order to get to the wholesale price. So the markup is based upon the actual cost of you to produce a product or to deliver a service, and it is much different, usually much higher than the gross margin. I think I've done an office hours presentation on the difference between gross margin and markup, but if you look online, and I know, by the way, that that's in the Awaken CEO Foundations course where we talk about that difference a lot more. But the markup is much different, and it is important for you to know that, because if somebody says they're operating on a 10% markup, that's a lot different than operating on a 10% margin. And by the way, it's a rare company, and I'd say almost no company that could operate on a 10% markup. 100% markup is really, really common, and I think that's the base that I encourage people to go for. And I also encourage people, as I mentioned earlier in the presentation, a 50% gross margin, which I don't know what the markup is that would represent, but it could be quite, I think that 50% gross margin represents 100% markup. The math is just a little complicated even for me off the top of my head, but fortunately there are a lot of tools out there that can help you, and I'd be happy to help you with that discussion as well. With that, I think we're going to wrap it up for today. I want to thank everybody who joined us for the office hours presentation, either live or who's listening and watching the recording. We do really appreciate you showing up and being interactive in our office hours presentations. We invite you to come back next week where we'll talk about event management. And in between now and then, if there's anything that we can do to support you in your business, please reach out and talk to us. We'd love to help you get clear and stay focused so that you can grow faster and make more money at your business. And until we meet again, this is Paul Hoyt and Stephanie May wishing you a most marvelous and prosperous day. Bye-bye.